Welcome to Part 4 of our series, The Cost of Capital, putting the components of the equity cost of capital together, presented by Dr. Stan Feldman.
Well, let's now put the components of the equity cost of capital together and calculate what the cost of capital would be if I were calculating it today. So the Treasury rate now is 3%. The market risk premium is 6, so that's 9. Let's assume it's a small firm with a 7% size premium, so that's 16. And let's say there's a 5% firm-specific risk, so that's 21%. So what we're looking at are cost of capital, just based on an equity basis alone, that is north of 20%. Now, if I compare that to the equity costs for well-known public companies like Apple and Microsoft or Amazon, firms like that, the cost of equity would be a fraction of what the cost of equity would be for the small firm we just calculated the cost of capital for. Now, what does that mean? Well, let's say, just for argument's sake, that we're comparing a small public company to a small private company, and the public company is a lot larger, small by public companies' standards, in the same industry, producing essentially the same products, and also having the same kinds of what I'll call equity risks. And so this small private company has a cost of capital 21%, and the public company might have a cost of capital, say 12%, or maybe 13 on the outside. Clearly, that 8% difference, 21 versus 13, means a lot in terms of the values of these two companies. So, private firms are risky for a variety of reasons. That risk shows up in the equity cost of capital, and we should know that these risks showing up in the equity cost of capital are risks that are associated with what I'll call the operations of the business. The operations of the business, the industry that they're operating, the size, obviously the size of the firm. And so these are what I would call, just generally speaking, the equity cost of capital reflects overall business risk. Now, in a moment, I'm going to describe what the cost of debt would be, but let's presume for the moment that we have a firm that's only financed with equity. And in my example, this equity what would investors require as a rate of return on such a firm would be in the neighborhood of 21%. And if, in fact, the firm couldn't produce a rate of return of 21%, its value would decline as a result. If, on the other hand, it can produce a rate of return in excess of 21%, then that would add incremental value to this company. So, again, smaller private firm has a much higher cost of capital, reflecting the fact that the operating business is far riskier than a public company essentially doing the same thing but being very much larger. Now, firms don't only use equity to finance their asset base. I refer to the asset base and capital structure. I use these terms simultaneously. But basically, if a firm has an asset base, and the question is, how's that asset base financed? And we can finance it, as we know, with equity, and we can finance it with debt. Now, the debt, as it turns out, has a required rate of return, if you will, that is less than equity. And the primary reason for this is because if a firm goes into bankruptcy, the debt gets paid before the shareholders or the stockholders get paid. So its cost necessarily will be lower than, in my example, the 21% used as the cost of equity. Now, what is the right cost of debt? So there are a couple of things we want to discuss, and then I'll get into the details of this. But just generally speaking, the debt that we're talking about is long-term debt. That is, it's on the books for a long term. It's in the terms of, usually for private firms, will take the form of bank loans. The loan is as a theoretical matter. When we look at the debt that private firms have, that this particular debt is not collateralized necessarily by any specific asset, but certainly the assets of the overall business. And therefore, as a result, that it's protected in some way, because if there's default, then the firm can't pay interest and principal, etc., then the bank could then simply receive those assets in lieu of payment of principal. And as a result, because it's protected like this, the debt cost to the firm is going to be a good deal less than the cost of equity. And for many firms, particularly firms that generate a lot of cash flow, they can afford to place debt on their books because the likelihood of default is low. And even though the firm itself is in a risky business, the debt, or the lender, I should say, in this case, is protected from the possibility of that risk, because the assets are, or the loan, I should say, is collateralized by these assets. So it's quite possible, and in fact often happens, that a 21% cost of equity capital might be associated with a, say, 8 or 9% cost of debt.
To continue this presentation, please see Part 5 of this video series, Debt Cost and Combining Equity and Debt Cost of Capital.